Okay, so here I actually want to get into annuities, life annuities, and what we're doing with those. So the first thing to realize here is that annuities, an annuity is just a stream of payments. And I've mentioned this a couple times before, but it's important to realize there's nothing special about it. It's a stream of payments. And again, if you've dealt with them before, it was probably a fixed annuity. I want to buy a house for $200,000. I want to borrow $200,000 to buy a house. I want to repay it over 30 years at 4%. What is my monthly mortgage payment going to be? That's a fixed period annuity. It's relatively easy to solve if you have a financial calculator or an Excel spreadsheet. You can't do it with a 4-function calculator. Mathematically, it's a little tricky. But point is, it's actually fairly simple if you have the tool that you need to understand the compounding at different interest rates and the interest factors and how that works. What we're introducing here is this idea, what if I wanted a stream of payments that would continue for the rest of my life? In other words, I have saved $1 million. I want to give that to an insurance company that's going to promise they're going to give it back to me in a stream of payments. And the risk part is it's going to continue for the rest of my life. So what I'm trying to do is I want to make it so that I have money that I cannot outlive. It goes for the rest of my life. And that's what I need when I'm in retirement. The unknown is how long I'm going to live. So it's super useful if an insurance company is willing to pay me. Now I have to pay for this. I have to give them a big lump sum of money up front, but they're going to agree to pay me those small monthly payments for the rest of my life. And the way it works, I'll show you a website that'll price some of these things out and make it a little bit clearer. But right now, if I had $1 million and I was 65 years old, I could give them that $1 million and they would probably agree to pay me about $5,000 a month for the rest of my life. Is that a good deal? Well, how would you figure it out? I can see you thinking about it, right? You're like, okay, well, I gave up $1 million. I mean, I didn't have to do that. I could just pay myself from that $1 million that I saved. I could just take $5,000 a month out and it would be growing at interest. So that $5,000 a month, how long would that last me to get through $1 million? And now you got the idea. If you actually calculate it out, I think you end up with about 14 years, give or take. And that's not factoring in interest. So it would be a little bit longer than that. So when you're 65, you're saying to yourself, do I think I'm going to live more than 15 years? If you knew you would, the annuity would be the best deal because the insurance company is promising to pay you that $5,000 for as long as you live. And if you knew you were going to live for 30 years, that would be a way better deal to do that. The trick is, what happens if I die 2 years later? Yep, that was the deal. You traded it for payments that would go for the rest of your life. And if you only got 2 years worth of payments, wow, the people who you're going to leave money to would really wish that you hadn't done that. You'll be gone. You won't care. But it's your heirs that you're trying to protect, that you're wondering about, well, what does that do to them? So what I'm really trying to do when I buy a life annuity is I want to make it so I can't outlive my assets. Otherwise, yeah, I got my $1 million. How do I know that that's going to be enough to support me? I don't, because I don't know how long I'm going to live. That's the problem. You can perfectly manage that risk by buying an annuity. And you don't have to do that with all your retirement assets. You could do half and half, right? Keep half of it, spend half of it. Then no matter what happens, you will be half right and half wrong. So it depends on how you view those kinds of things when you make those kinds of decisions. But that's a hedge. And that's not a bad hedge to say I'm going to spend half of my retirement assets on an annuity and the other half I'm just going to let it ride and we'll see what happens. The thing about an annuity that's really cool is it's the exact mirror image of life insurance, right? Think about life insurance. What's happening? You're making small payments, usually monthly or quarterly or yearly. You're making these small payments, and if your life comes to an abrupt end, a big payment will be made to your beneficiary. This is just taking the process and flipping it. I'm going to give them a big amount of money, and out of that, they're going to pay me smaller monthly payments that will continue for the rest of my life. So the risks are exactly the opposite. If I'm the insurance company, I'm selling life insurance. What's the risk? The risk is that somebody buys life insurance and dies very soon thereafter. I'm selling an annuity. I'm the insurance company. What's the risk? Well, the risk is they give me the big lump sum of money and then I have to make payments and they live to be 120. Whoops. That one I'm not going to make money on. Again, we're pooling these things together, so we don't really care. Some people are going to outlive their life expectancy. We know that. And some people won't. We know that too. It's all factored in. It's all pooled together. And it's the law of large numbers that helps us predict what our costs are likely to be. Okay, so you are making these periodic, you're receiving these periodic payments once you've made the big lump sum and they're going to pay you back. It could just be a fixed annuity where they pay you the same amount every month for the rest of your life and it never changes. Sometimes people say, well, hey, I expect to live 25 years and inflation matters in 25 years, right? So you're paying me, I gave you $1 million, you're paying me $5,000 every month. Today, that's enough. 25 years from now, it might not be. I'm still going to get $5,000, but that $5,000 doesn't buy as much. So maybe I want to invest in a variable annuity. So what they're going to do is they're going to take my lump sum and invest it in choices that I make. And if they do better than we expect, my payments can go bigger. And if we don't do as well as I wanted to, well, my payments will be smaller. So I'll be taking investment risk there if I take a variable annuity. Immediate and deferred, that has to do with when you're taking payments. So the example I've given up until now was the immediate annuity. I give you $1 million today, you're the insurance company, and then I immediately start to take payments. So a deferred annuity is I'm making payments into this annuity, but I'm not taking payments out. A deferred annuity, I might start when I'm in my 30s. And I start making deposits into this deferred annuity, saving for retirement, trying to build up to that $1 million. And then some point in the future, I'm going to take payments. That's a deferred annuity. So immediate and deferred, that's different from fixed and variable. I can have an immediate fixed annuity. I can have a deferred variable annuity. I can mix and match those terms. An immediate annuity is always going to be a single premium annuity. So I could have an immediate single premium annuity. I give you $1 million. I start taking payments the next month. That's an immediate single premium annuity. I could do a deferred single premium annuity. I'm in my 30s. Maybe I win the lottery. I set aside $500,000 and then I just invest that and let that grow and I never make another payment in. That means I only paid one premium. It's a single premium annuity, but it's deferred. I'm not going to take payments till later. So that's an example of a single premium deferred annuity. Those are going to be rare, but it's possible. A flexible premium annuity. So on the way in, it's a flexible premium deferred annuity, for example. Okay, 1 year I put aside $1,000. Next year I put aside $2,000. Year 3, I don't put aside anything. The premiums are flexible. I'm not going to make the same premium payment every single time. We can set it up that way, and those can be deferred. And they can be fixed or they can be variable. You know, they can tell me, yeah, you're going to earn 4% on whatever you put in. And that's a fixed annuity. We promise you that rate. Doesn't matter what the outside interest rate environment is doing. We promise you 4%. That's fixed. Could be variable. We say, yeah, you put in as much as you want every month, and the returns are going to be based on the investments that you choose. That's a variable annuity. That's a flexible premium variable deferred annuity. You see, we can use all these terms. So these are all descriptors. These aren't 6 different kinds of annuities. These are different features of annuities that get combined together. Okay, so up until this point, taking money out of the annuity, I've talked about annuitizing that as taking monthly payments for the rest of your life, and that's what it's intended for. If you had a deferred annuity, you could just settle for cash. In other words, you could be saving up, and the goal was, I'm going to turn this into an annuity that pays out. You could say, I've changed my mind. I just want my money right now. That's okay. You can do that. That's settling your deferred annuity for cash. You wouldn't settle an immediate annuity for cash because that wouldn't make any sense, right? I just gave them $1 million, and settling for cash would mean I'm asking for it back. That's weird. Why would you do that? You're not going to settle an immediate annuity with cash. Most of the time, this is what we're talking about. A life annuity gives you payments for the remainder of the rest of your life. The risk, right, is the problem is I've given you $1 million. What if I die in 2 years? Then I'm going to be feeling like, wow, I really overpaid. Or my heirs are going to be feeling like, wow, I wish he hadn't done that. He wasted $1 million. If he'd have just taken his $5,000 a month payments from that $1 million himself, he'd have a lot left over that he could have then given to us. And so people are usually cautious about this. Most people, when they buy a life annuity, they don't buy a straight life annuity. They usually buy a life annuity with at least a period certain. And that says, this is worth me defining this. Let me go ahead and write this down. These are all going to be worth me writing down. So annuity with period certain. What does that mean? So this will pay monthly payments for the rest of the insured's life, or for a specified period of time, whichever's longer. So I buy an annuity with period certain, and I say, all right, I want a 20-year period certain. That means they'll pay me monthly payments out of my $1 million for the rest of my life, or for 20 years, whichever's longer. So if I die in the short term, then this helps protect, and it guarantees that there's at least 20 years of payments. But if I live longer than that, it will continue to pay for the rest of my life. Now, the interesting thing about this, obviously it costs something to add this option. But instead of you paying more upfront, like we don't say instead of your $1 million upfront, that's going to cost you $1.2 million. The way we price it is it's a lower monthly payment. So instead of getting $5,000 a month, if you want an annuity with a 20-year period certain, you might only get $4,500 a month. I'm making up the numbers. I will show you a quote engine where we can view these things. Same risk, but we're going to handle it a different way. Comes about when you talk about the installment refund option. That one just guarantees that you at least receive payments back equal to what you put in. So if I paid $1 million, they'll pay me for the rest of my life, or until they've paid me back $1 million, whichever takes longer to do. So if I die quickly, they will continue to pay to a beneficiary until the full $1 million is paid back. And in that case, I just lose the interest on that money. Or we can do a joint and survivor annuity. That one is going to pay for two people's lives. So this one is really common for spouses to use. So this one will pay monthly payments for the duration of both for the duration of two people's lives. You could specify and I'll go further and say until the second one dies. That's what I'm trying to say. So it's longer. So I buy an annuity and it pays for the duration of my life and one other person, probably my spouse. But you could name somebody else. That would just change the payment amount. And it's going to be based on life expectancy, right? So they'll pay monthly payments for the duration of two people's lives until both people are dead. So until both have already died. So we're managing the same risk there. And that's kind of a neat way to do it. And then you can combine these two options. You could have a joint and survivor annuity with a 20-year period certain, and then that guarantees that even if both people die, we still have 20 years that are getting paid to a beneficiary. So in all those cases, what we're trying to do is prevent this problem where, otherwise a straight life annuity pays me for the rest of my life. Great. What if the rest of my life is short and I just gave you $1 million? That's the problem. So period certain, joint and survivor annuity, that's the most common way to handle that. Installment refund is less common, but you could do it that way too. When we have the idea that goes with variable annuities, so remember, these are the ones that are going to change the size of your payment based on how the stock market does and the investments that you choose. So what's happening here is that helps hedge against inflation. That's the idea. The idea is that future stock prices will rise at least according to inflation. And so that will be enough to at least hope that your investment keeps pace. So your purchasing power of your monthly payments remains constant. That's the idea. When you buy a variable annuity, usually what you do to protect against the idea, well, what if I die and the payments stop? There is a guaranteed death benefit option that will pay your beneficiary usually the lump sum that you paid to get into the annuity. So you've got a little bit, you could think of it as life insurance wrapped within the annuity. That's one way to think about it. These are expensive things. And so be very careful. You really need some outside advice, in my opinion, to make a good decision here that involves a variable annuity. Remember, this contract lasts for the rest of your life. You might be at retirement age. That's where it's valuable, right? I'm not working anymore and I need money coming in. I've got a big lump sum. I could just take from that, but I'm worried that it might not last my whole life. So I want to buy an annuity. How do I go about doing that? This is a complicated thing. The options get real complicated real fast, and it's a really good place to have a third party look over what your plan is, no matter how much you think you know, just to make sure there isn't something that you missed, because these things are expensive. This is a good time for me to show you this quote engine real quick. I just want to show you what I've been talking about here. Yeah, this will work. We'll just take 5 minutes to do this here. So let me get to the internet real quick. So yeah, I'm not the first person to go here. Immediate annuities. So these are all immediate annuities. It gets much harder to try to price this stuff out when you want variable annuities. There's a lot less to rely upon. So, okay, I've been talking about what if you had $1 million and we want that, you're retiring right now, so we want the payments to start immediately, right now, today. Okay, well, if you were 65 years old, and if you were, I'll start with male and we'll package in the female here. They want the state just because they want to make sure that whoever they're going to funnel you to is licensed to sell in Indiana here in this case. And then if I want the joint and survivor options, I have to specify who that second person is going to be. And they want to know male or female because that has implications for life expectancy. Who lives longer, men or women? Women live longer. What does that mean? Well, it means that they expect to make more payments. So if everything is the same, but one is a man and one is a woman, and they're both putting $1 million into an annuity, the payment for a female will be lower because they're going to have to make more of those payments. The payment for a male will be higher because they expect that they're going to have to make fewer of those payments. They expect the man to die younger. And that's just what it is. So, I mean, you could use whatever age and gender you wanted for the second person. I'm just saying, all right, if you had a traditional family spouse, this is what that would look like. So, okay, here are some of the quotes we can look at. So it's kind of cash refund is just installment refund. I think I need more quotes here. They've changed this website. Okay, yeah, this is good. Okay, so what if I'm willing to buy, if I want a life annuity? Oh, okay, these are joint life. That's why. Okay, so if I wanted a joint and survivor life, they would give me $4,000 a month. So this is paying on two people's lives, and we're assuming that they're both 65. What if I wanted, now with the period certains, these are not joint and survivor, and that's why. So you can actually make some assumptions here. If I just wanted to buy a straight life with 25-year period certain, with $1 million, they would pay me a little over $4,400 a month. If I want joint and survivor, they're only going to give me $4,000 a month. All right. And that's because they expect, so I can tell that means they expect the two of us to live longer than 25 years. Because if I'm willing to remove joint and survivor and only take a 25-year period certain, my monthly payments actually go up. That's because they're assuming that the two of our lives together will go longer than 20 years. Another way to look at that, I want a joint and survivor. I want a joint and survivor annuity. Okay, great. For $1 million, they'll give me $4,024 a month for the rest of both our lives. What if I want to add a 10-year period certain option? That only costs me $5 a month because it's extremely likely that by buying a joint life and survivor, by a joint and survivor annuity, we're going to live longer than 10 years. So I've already got that built in. And to add on the 10-year period certain only costs me $5 a month because they're saying, yeah, it's already pretty likely that that's going to happen. If I'm only looking, you get closer to 5,000 if it was just me, the male at 65. And then you can look here, adding on period certain options does start to reduce how much you get. And then they've got the installment refund where they say, yeah, we pay out until we paid out at least $1 million. Okay, that's going to, instead of getting $4,900 a month, then I get closer to $4,400 a month. You can compare the male and female. I told you the men's payment should be higher because they tend to not live as long. Women are going to live longer. That means that their monthly payments are going to be less, $4,595, so $4,600 instead of $4,900. I mean, that should make sense. Okay, you've seen this. It's immediateannuities.com if you want to play around with this. Some Friday, Saturday night, you got nothing going on. I understand. I get it. I do it too. Go ahead and check it out. But this is a really good place to stop. We will pick up with this. The slide after variable annuities talks about taxation. Yeah, that's a good place to stop. We'll start up with taxation of annuities next time. Thanks a lot for your attention. And if you have questions, send me an email and we'll handle it from there. Love talking about this stuff. So you're not bothering me when you send me an email. Don't be afraid to do that.